Do you have an exit plan for your business? Do you know when you want to exit? Do you know how much you need to make? Those types of questions are really important to answer at any stage of your business, whether you want to sell and exit your business soon or whether you want to wait a few years. Those questions are really important. But what if you don't have the answers to those questions? Well, today's video is all for you because that's what we're talking about today. My name is Adam Hanneman. Welcome to Ramblings of a Geek. I've been in the MSP space for the better part of a couple decades, and I've seen quite a number of different things. I've talked to lots of MSPs about their business plans, about their exit plans, and thinking about whatever that future looks like for them and how to exit their business gracefully, because time is an undefeated opponent. So if you're going to exit the business one way or another, so let's do it planfully, mindfully, and with intention. So that's what we're talking about today, everything about exit plans. The first question might be, why do I need an exit plan, right? Whether you're going to exit here in the next 2 or 3 years or 10 or 15, having an exit plan is really important. It's important to have a destination in mind with where you want to take your business, where you want to head and drive things towards, because when you have a destination in mind, even if you change destinations along the way, you're still going to move your business along a lot further than you would had you just been moving along at kind of whatever thing you want to aim at today or tomorrow, right? You want to take a long-term view of the future and really lean into that. So if this exit plan is so important, there's some pieces that go into it that are also important, right? The first one is, when should you exit? And that answer to that question is a whole lot of it depends, right? When do you want to be done working? When do you want to do something different? What does that look like for you? What does that next stage of your life look like? Because when you think about exiting, it doesn't mean you have to retire. It just means that you're stepping away from the business. It also means you don't necessarily have to sell the whole business. Maybe you're just stepping away from the day-to-day. Eventually, you do need to sell and have a plan for it, but there's different stages of what that might look like. And the important piece with all of this, though, is to understand sort of the time horizon of when you want to start stepping away, whether it's full step away or partial step away, because the sooner that event is designed to happen, the less time you have to make changes, right? If you're trying to exit in 1, 2, 3 years, you have a lot less time to make big changes. So if your valuation or something like that is too low, then it's really important that you understand what that looks like and do your best to move it in the right direction. If your exit is 5, 10, 15 years in the future or 20 years in the future, you've got a long runway. And so it gives you a lot of opportunity to make smaller changes now that pay off bigger in the long run. So understanding the when is really important. So then let's talk about valuation for a minute. And valuation is going to take me a couple minutes to get to because it's really important and it's kind of a big topic. Now, I also should throw a caveat out here is that nothing you're going to hear from me on today's video is going to tell you what the value of your business is. If you want to understand the true value of your business, you need to pay a professional business valuation company. That's really important. I'll drop a link or two down in the description of this video with some folks that I recommend. So with that out of the way, let's talk about some generalities, because I think that's really how we're going to get through this and how you're going to be able to kind of essentially back of the napkin figure out kind of what you're looking at. So let's set some foundational concepts here. First concept is that if you invest about $1 million in the stock market, in various investments, you should be able to generate about $50,000 a year of income for that. Now, your mileage may vary on that. It might be a little more, a little less, but the idea is that if you invest about $1 million, you should get about 50 grand a year back in income that's not impacting that principal. If you need $150,000 a year to live off of, that means you need to sell your business for about $3 million or have $3 million of investment. So you could extrapolate that relatively safely that way. Let's talk about what a $1 million company looks like, because you could extrapolate further from that. So to generate $1 million valuation, you're going to need about $200,000 in Adjusted EBITDA. Now, it's important about how you get to that $200,000 in Adjusted EBITDA, but generally speaking, if you're able to generate about $200,000 in Adjusted EBITDA, you can probably get a valuation in that $1 million range. Now, obviously more is better when it comes to that. And if your business is largely break, fix, and hardware, then $200,000 is going to climb relatively quickly. So if you have a solid managed services practice that's recurring revenue, those things are going to really drive that valuation up. So it's important. The revenue mix is important, but generally speaking, $200,000 of Adjusted EBITDA, especially if you're able to kind of do that over time and show consistent growth and those kinds of things, that's very likely going to get you near that $1 million valuation. So if you need a $3 million valuation, you need $600,000 of adjusted EBITDA. It's, again, very back of the napkin, very high level, but that gives you a pretty good idea of what that looks like. Now, the next logical question is, well, what does a $3 million company look like? Well, that's a little bit out of scope for today's video, but rest assured, I will be coming back to that in a future video. In the meantime, I'll throw a couple different videos up above and in the end screen to talk about some of the different sizes and kind of phases of your company, because as you move through those phases, those things become really important. So I just threw a term at you that I haven't explained before, and that term is adjusted EBITDA. Adjusted EBITDA is a modification of regular old EBITDA as it relates to taking the owner's salary or expected owner salary into account. Now, what you're trying to do with adjusted EBITDA is to understand what the company's profitability would be like if you had to pay somebody full freight, full rate to replace you as the owner, right? So if you hired somebody like me to replace you as the owner within your organization, and you could kind of watch things from the side, what would that look like? Well, that going rate from that range is somewhere in that $150,000 to $200,000 range. Let's just call it $150,000 for now, just to make the math a little bit simpler. And we care about adjusted EBITDA because it really tells a more complete story about how much you're really making as an organization, because it's entirely possible that you have pretty solid EBITDA numbers, but you're paying yourself $0 as a paycheck and you're taking all of it on the back end. Well, your EBITDA is inflated because of that, right? So adjusted EBITDA tries to normalize that as best as it possibly can. So if you are paying yourself $50,000 a year as a relatively modest paycheck, and you're taking the rest out of your balance sheet as a distribution, whether it's monthly, quarterly, whatever, you would account for this in adjusted EBITDA by actually taking another $100,000 hit to your overall EBITDA for the year, and that's an important piece to think about. Is that if you are underpaying yourself now, and you should be paying yourself whatever makes sense from a CPA, financial stability of your organization type of a thing, but this adjusted EBITDA allows you just to normalize that. So let's just say, again, you're paying yourself $50,000 a year and everything else on the balance sheet, then your adjusted EBITDA would actually say that you actually take a haircut of $100,000 off of your EBITDA at the end of the year, right? So that's how adjusted EBITDA would work, right? You're trying to normalize your EBITDA based on what it would cost to replace you as the owner of your business. So to generate that $200,000 in adjusted EBITDA, that really means that you need to then take that $200,000 and do some math against it. Now, if you are running your business at the kind of the top level efficiency and those kinds of things, you can probably pull about 20% of adjusted EBITDA from your business. But most MSPs don't run that lean, don't run that efficient. Usually they're in that 10 to 15 range. So this is where knowing your numbers is really important, because if you know what your normal adjusted EBITDA percent is, then you can extrapolate exactly how big of a company that's going to be, right? So the idea, and this is why I talk about it's important to get your gross margins dialed in early. It's important to get your EBITDA dialed in early, and all these different pieces, because the earlier you understand and master your financials, the easier it's going to be to get to whatever that longer term target's going to be. But let's quickly extrapolate what this might look like. If you need $150,000 in annual income, that means you need about a $3 million valuation of your business. And if you need a $3 million valuation of your business, that means you need about $600,000 in adjusted EBITDA. In order to get that $600,000 in adjusted EBITDA, you need to generate somewhere between $3 and $3.5 million of revenue to get to that $3 million valuation. Now, the better you are on the EBITDA side, and the better you are on being able to be efficient and all those kinds of things, that maybe the lower that is, and the worse you are at that, you might be 3.5 might be the low end. Maybe you're closer to 4, but that's kind of what that might look like for you in your business. So now that you have an idea about what your exit timing is and what your exit targets are, it's time to get working on building a plan to get there, right? That's the whole point of all of this. Hopefully my videos are helping you derive that plan. I'll continue to make videos to help you along the way. In the meantime, if you want to see a video about kind of the growth stages of an operations team, I'll put that video up here. And if you want to see the ownership, kind of the more of the ownership role, I'll put that video up over here as well. Thanks for coming on this ramble with me, and hope to see you on the next one.